What are the interest rates at pawn shops? Have you ever wondered how pawn shops operate and what their interest rates look like? Let's break it down in a simple way. Pawn shops are unique businesses that provide short-term loans to individuals who bring in items of value as collateral. The interest rates at these shops are a key part of their business model and have a big impact on the people who use them. So, what exactly is an interest rate? It is the cost of borrowing money, expressed as a percentage of the loan amount. This rate compensates the pawnbroker for the risk involved in lending money, storing the collateral, and covering potential losses if the borrower does not repay. Interest rates at pawn shops can vary quite a bit. They depend on factors like location, local laws, and the type of collateral being pawned. In many areas, monthly interest rates are regulated and usually range from about 2.5% to 3% per month. When you look at this over a year, it can translate to an annual percentage rate of 30% to 36% or even higher, depending on how the interest is calculated and if there are additional fees. Some pawn shops, particularly in places with fewer regulations, may charge much higher rates, sometimes exceeding to 100% annual percentage rate. This can be a shock for some borrowers, so it's important to be aware of what you are getting into. From an economic anthropology perspective, pawn shops are often seen as alternative financial institutions. They serve a diverse range of customers, not just those who lack access to traditional banking services. Many people from different backgrounds use pawn shops for quick and discreet loans, especially when they need cash fast and want to avoid the lengthy process of traditional bank loans. The interest rates reflected both the risk taken by the pawnbroker and the convenience offered to the borrower. Unlike banks, pawn shops do not require credit checks, making them accessible to a broader audience. However, the higher interest rates mean these loans can become costly if not paid back quickly. For example, if you borrow $100 at a pawn shop with a 3% monthly interest rate, you would owe $3 in interest each month. If you do not repay the loan within a year, the total interest could reach $36 or more, depending on the specific terms. If repayment is not possible, the pawn shop retains the collateral and sells it to recover the loan amount. Understanding the interest rates at pawn shops is essential for anyone considering this type of loan. It also plays a significant role in studying how informal financial institutions operate within market systems, especially in communities where access to formal banking is limited. The rates and practices of pawn shops reveal much about economic strategies and how people manage financial challenges in their daily lives.